We'll probably get started now, and we'll let people come in. But certainly excited to get this one underway. I'd like to welcome everyone to Forge and Foster's second quarter market update. My name is Ben Ames, and I will be hosting this update. But I'm very excited to introduce some speakers here that we think are going to provide a lot of insight and information for what has been certainly an interesting quarter to start. I think we've lived in this post-COVID world for a few months now, and we have a little bit better of an understanding as to what the day-to-day may look like, but how it shapes the next few years is still to be understood. And I think the speakers that we have here today can certainly shed some more light into what that future could look like, as well as different impacts on our market that can be had either through post-COVID or prior, but certainly are affecting underlying trends. So with that, I'd like to introduce our speakers for this call. First speaker today is Forge and Foster's very own Alex Manojlovich. Alex is our investment and research associate at Forge and Foster, and he'll be providing a second quarter update on the greater Hamilton area real estate market, including impacts of COVID-19 and what that looks like for the rest of our year. Our second speaker today is Sarah Wayland, PhD. Sarah is Senior Project Manager of the Hamilton Immigration Partnership Council and is a community planning table host with economic development team at the City of Hamilton. Sarah is providing an immigration overview for both Canada and Hamilton. And finally, we have Peter Paul van Hoeken, who is founder and CEO of FrontFundr. FrontFundr is the leading online B2C private market platform in Canada. And Peter will be discussing online investment in the private markets. So with that, I will hand it over to Alex, our first speaker. And Alex, you can take it away.
Thanks, Ben. Just give me a second to share my screen and we can go. Okay, thanks, Ben, again, and welcome everyone to the Forth and Foster Q2 market update. Thanks for tuning in. As we look at what happened in the second quarter for Hamilton and beyond a little bit too. And it's an interesting quarter too, because it's going to be our full quarter that we've lived through this new COVID environment. We did our Q1 update for the first time through Zoom, and this is our second one. And so some of the things that we were trying to extrapolate then may have or has more light shed on it now that we've lived through a few more months now than when we first initially tried to analyze back then. So what happened in Q2, very simply put and touching on March 23rd, also the 16th, social distancing enforcement and non-essential workplace closures were established. And so that kind of really shut down everything. Everyone wanted questions or answers to questions of what was going to happen. And now, between then and now, we've seen the province enact stages to slowly reopen the economy. And I think not just the economy, but just kind of our mental health and preservation. We've also just kind of adapted in this new environment they're living in. And we can kind of see that through the commercial real estate market in Hamilton as well. So some things that economists have seen during this Q2 period is that it looks like that April is going to be the toughest month during our time in COVID right now for many facets. So it's just some examples that I found here that kind of show that these trends is that housing starts for April 2020. So construction starts were down to 160,000. The initial prediction was 205,000. And now that we're in June, it's gone up to close to 200,000. So it's coming back to normal levels. Job losses were decreased by 2 million in the month of April, which was a record. And in June, we recovered 1 million jobs, which is a total of 40% of the total lost. That's including March and the month subsequent to that as well, which is also a record. So we're living through these crazy times that are just seeing huge jumps in either direction. And so it's a great time, or at least for the Q2 period, to really analyze what happened and what to base that off of. And then lastly, April unemployment rate was 13.1. It went up to 13.7 in May, and now it's dropped to 12.3 with that increase of 1 million jobs in June. So just to really emphasize this point again, these are various kind of looks or metrics from various facets again that kind of display the overall point that April looks to be the lowest point, the nadir going forward. So whether it be consumer spending, small business spending, commuting even, or the last graph, you can't really see title, but it's the TSX and S&P stock market index. It really shows a huge cliff dive in April, but there is a long and gradual progression happening towards a recovery. Overall in Hamilton, how has this affected the commercial real estate market? As you can see here, quite substantially just from the volume. And we've seen the same thing in Toronto as well. Toronto is always kind of a good watermark to compare to Hamilton, because Toronto is kind of the epicenter of action, and it kind of ripples out through the various markets as well. So as you can see, 51 transactions happened this past quarter comparatively to last year with 83. So I wanted to see if this is just a one-off. So I looked at the previous 4 Q2s as well, starting from 2017. And overall, the general sentiment for the real estate market is there's a strong spring and then a slower summer. As you can see, in 2017, it continued to increase, but 2017 it was actually one of the greatest years that we've seen for quite some time. And when you compare the rest of the years to 2020, you can overall see a lessening or a lower transaction volume comparative to the past years. And you can see that quite the impact of COVID. When you look at value, the value is still there, even though surprisingly that you see almost half the transaction volumes. And this is mainly in part the 2 outliers that happened in Hamilton. And we'll touch on those. So when you look at by asset class of what transacted in Hamilton, very minimally do you see anything really kind of moving the needle, except as you pretty evidently multi-residential is very much skewing this graph here for one purchase in particular. And there's one large purchase as well in the commercial, industrial, institutional land as well. So I usually do like the top 3 transactions that happened in the quarter. The third highest one, nothing really too interesting to talk about, but I'll just touch on that. It was some student housing in the west end of Hamilton, located close to McMaster University. Something to keep in mind is the site directly below it on the screen, which is across the street, which was actually purchased for a potential development. And we'll touch on some developments that were announced in Q2 in Hamilton. The second highest was that commercial land that I touched on. This is off 50 Road, off the QEW towards Stony Creek and St. Catharines in Hamilton. It was purchased by Crestpoint for $63 million, almost 20 acres, which puts it at a valuation of $3.3 million an acre. And this is located by Costco. So I think we'll get on it later, but the rhetoric is that retail is diminishing, but there still will be a presence, and Crestpoint values that as well, especially off a high density increasing area in Hamilton, or a growing area. And then lastly, the largest transaction that occurred in Q2 for Hamilton was 140 Main Street West, which was a total purchase of $142 million by Quadrille Property Group, which is a large institutional firm with a portfolio that spans the globe. They purchased this 321 units, 26 stories. This is located right downtown Hamilton. So all in all, that equates to a $443,000 per unit purchase, which is some of the largest I've seen transact in Hamilton for a multi-residential valuation. Interesting enough, I added the last point here, is previously purchased by Starlight Investments, which is another institutional group, in 2017 of the same quarter for $80 million, so almost half. So you can really see that huge appreciation happening in Hamilton. And it's great to see the multi-residential sector still kind of attracting this type of attention, especially in the core of Hamilton. Also, I wanted to touch on that that developments still seem to be focused. The development activity has not waned, even though actual construction has been mitigated due to various COVID restrictions. The actual development and planning of development in Hamilton has not been stifled. And these are just a few examples of some announcements that happened in Q2 in Hamilton, not all of them, I should emphasize. So the first one, I'll just touch on these. 1107 Main Street West. This is the site directly across from that first transaction that I mentioned before, and it's a proposed 15-story condo with 300 units. That's by Innate Developments. The one to the right of that one, Jarvis Street in downtown Hamilton, 14 stories, 370 units proposed, multi-residential as well. That's by Emblem Developments, which is the private equity arm of First Avenue Council. Next, West Harbor. This is a development that's already been in the works through the city. It was awarded to Citizen Group in Fernbrook, but KPMG, which is a large architecture firm in Toronto, was awarded it. And part of their LPAT proceedings had them agree to a proposed 45-story tower, which would be Hamilton's tallest building if it does go through. So that's going to be on the water's edge of Hamilton. And then lastly, 77 James Street North, also Innate Developments. This was part of a design review panel that is the location of the old city center in downtown Hamilton, which was purchased last year. So it's good to see some development happening in that direction. The proposal currently is 4 stories, 3 of them being 30 stories, the one on the right being 24, and overall the proposal is over 2,000 dwelling units. And just last Friday, I read a headline, didn't have a chance to delve into it, is that the city agreed to pursue a development with a group in Hamilton over $500 million for the revitalization of the arena, which is adjacent to 77 James Street North, and a couple other entertainment venues in Hamilton. So development activity and future thinking in Hamilton is still strong for the Q2. So what to look for going forward. Overall, just looking at this Q2, it seems that there is a sentiment from various levels of buyers that whether a length of time, whether it be 2 years, that is going to be a strong fix of COVID. After that, sentiment is still strong. What's been the key driver, or recognized as a key driver of commercial real estate and residential real estate, and not only in Hamilton but the rest of the nation, has been immigration. Ryerson University Center for Urban Research produced a study this past quarter that looked on numbers from last year, and it showed that Toronto is the fastest growing metropolitan area and city in North America. And if you look at the first graph here, it shows that there are natural increases in international migration increases. This is comparing Toronto in blue to New York in yellow. However, there's a net negative net migration coming out of Toronto. So what that kind of shows is that there is a population that's coming out of Toronto and revisiting, hypothetically, or what you would think are people in the immediate areas or cities in the immediate areas such as Hamilton. And if you look at the next graph, it shows the top 20 central cities by population growth, so sheer population growth. And most of them are Canadian. This also looks at the US as well again. And if you look at the very bottom, Hamilton is on the graph. So Hamilton is the 20th fastest growing city in North America, at least last year it was. So I think that provides credence to that argument that potentially you might see some spillage coming from Toronto into the Hamilton market and the various markets as well. And just talking with some realtors, just from daily work life, you're starting to recognize that you are starting to see some buyers coming from Toronto. I think there's even a Globe and Mail article talking about these points a couple of weeks ago as well, especially in Niagara as well, where you're seeing an increase of interest from Toronto buyers. So overall, what do the asset class looks like, or what it looks like to portray? Multi-residential, we kind of touch on this, even though various rental rates are starting to soften, except for maybe the industrial rates, demand is still there, and it's projected to be for the future. Industrial class shares the same projection. We've talked about this at length prior. Due to the increase of e-commerce, you're starting to see a shift from retail into industrial, and a huge growth into industrial. And part of the jobs that were recovered that we touched on prior is that the sector was service sector and part-time jobs. However, some of these jobs may be lost forever, unfortunately, due to just retailers just not being able to survive this time. And you look at in the news, JCPenney, Aldo, David's Tea, these places have filed for vacancy or are in pretty rough shape. So there have to be a way to try and recover these jobs. Also announced recently that Walmart is going to be building a 500,000 square foot facility in Vaughan for the industrial distribution center. So you just continue to see stories like that as well. So again, you're going to continue to witness an accelerated shift from retail and industrial. And this has been happening before COVID. It's just being accelerated now, especially that we're kind of in these lockdown measures. However, this isn't the total death of retail. In my opinion, retail will continue to exist, similar to that Crest Point purchase, where you do have retail that is in close proximity, within a walking distance, within a short jog some multi-residential density, you will see these being supported by these commerce asset classes. The biggest question is the office. What's going to happen with office? As people are working from home, you're starting to see numbers that efficiency is still high. People are able to work from home for the most part. So what does that say about your normal employment space before COVID? So currently we're seeing vacancy and rental rates are softening. This is happening in Toronto as well. Subletting is increasing as well, which is reducing your demand. However, rates are still kind of the same right now. They're only beginning to soften. And I think what this is going to show is that office is more valued for a place of collaboration and connections and social welfare. And so those are going to be the values that are going to be pursued when people are going to be looking for office in the future. So how do you attract those tenants back to the office? And it's going to be measures that are going to have to look at air quality, physical distancing, enhanced cleaning, personal health, and education. You're going to see, or we are seeing, huge investments in prop tech. I think it was just announced last week that Canada's first accelerator for prop tech, Reaches, was being funded, I think, in Vancouver. So you're going to see more measures of that nature to improve working environments in order to attract those A tenants now that they have a little bit more leverage since demand is projected to be a bit softened. And then secondly, it's going to be the location as well. If your people are going to be coming to the office, it has to be a place that is worthwhile going to. So that might be places that are located in downtown cores, close to amenities, as well as potentially other tenants that kind of share some collaborative and related information and insights. So one thing I should point out too, I was actually listening to a webinar with Michael Turner, who's the president of Oxford Properties. He kind of compared this sort of pandemic, which is life-changing, daily life-changing, towards 9/11 when that happened, when he was working through that period. And some analysis was trying to come through that. And through his experience, people were saying, no high-rises are going to get built. No one wants to live on a top floor. Flying is going to be heavily mitigated. It might ruin the industry. So all those things, years later, of course, currently, or before COVID at least, did not come to fruition. And so I think with that lens to approach this situation is not to make too grandiose predictions, and that they recognize that this will end eventually, and that there will be a new environment that we come through, but it'll have to incorporate these behavioral changes. It'll just kind of be, we'll just have to figure out how to navigate that, but it won't be too such an extreme. So where are we going to see pivoting? You've already witnessed this in retail, primarily with multi-residential. I've seen many REITs that have a high retail exposure, such as RioCan, Smart Center, start adapting high density multi-residential to reduce their exposure to their retail assets. One that you might see is, maybe hasn't happened yet, but maybe last mile distribution, data centers, logistics. If you have a large mall type space that is kind of the bare bones of a warehouse, maybe you start seeing it shift to industrial. And then what about office? Is office going to have a pivot? I think you might see maybe office becoming a bit more flexible as there is more leverage towards a tenant. Maybe some primary office space might have to introduce some co-working measures in order to offer that flexibility and that availability for just general office users as they get more accustomed and to working from home and just having a different working environment that's not permanent. There will be opportunities from this, and we've seen this looking at some of the larger institutions as well. And again, this is kind of emphasizing the point that there will be a positive end to this. There will be an end to this. And just to show that is just that the REITs have accumulated dry power to do an acquisition spree, whatever that may be. And an example I have here is Brookfield Asset Management closed on a $15 billion fund just at the end of last year. And then Blackstone raised $20.5 billion vehicle for purchasing after COVID as well. And that's a record. So institutions recognize that there will be an end to this. There will be opportunities. Commercial real estate will come out of this. And I think we will come out of this too. And it's just on us to just kind of monitor the situation, make sure we're doing the continued safety measures that we've been pursuing and that have been implemented and provided to us. And just to be wary of a second wave. A lot of economists have kind of nailed on that point. When is the second wave? Will that provide a significant pushback? And some people are thinking that might happen at the end of the year when flu season naturally happens. But just to be cognizant of that, not to get a hold of ourselves, too ahead of ourselves, and things should work out for the better. And with that, I'll pass it on to Ben. I just want to say thank you, and I'll answer any questions at the end of this presentation.
Thank you, Alex. Appreciate the insight there. Certainly a lot to unpack. It sounds like there are there's a lot of capital available right now, so it'll be interesting to see the next kind of 6 months to year how that capital gets allocated and what that does for different markets. But yeah, like I said, I'm pretty excited to introduce the second speaker here, Sarah Wayland. We were chatting previously before the call, and Sarah, you've got an interesting T-shirt there that might be worth highlighting.
Oh, I don't know. Hamilton is home.
Nice.
Yeah.
Right on. Well, with that, I will hand it off to you, and look forward to the overview.
Great. Well, thanks for this opportunity. And yeah, my name is Sarah Wayland. I've worked for the City of Hamilton in economic development for a number of years, and currently I'm the Senior Project Manager for the Hamilton Immigration Partnership Council. And what Alex and I talked about that you'd probably like to hear is a bit about immigration generally to Canada and a bit more about Hamilton. So, okay, now I'm going to. So why immigrants and immigration? If you're following this issue at all, you know that we have below replacement rates in fertility in Canada, and that we have fewer and fewer people in our workforce that are working to support retirees. And you can see from this infographic that's created by the federal government that in 1971, we had 6 workers for every retiree. And within less than 20 years, we're projected to have only 2 workers for every retiree. So you've seen a slight growth in immigration in the past few years in order to try to mitigate this trend. We also know of interest to this group is that immigrants are more likely to start a business than the Canadian-born population, and that immigrants generally are not job takers, but they insert themselves into the economy in ways to fill gaps. And as you will hear from our next speaker, Peter Paul is a kind of a living example of a recent immigrant to Canada who is creating jobs and creating businesses. So I just thought it would be helpful to give you a really high-level overview. This is, we often hear Canada referred to as a country of immigration. This is permanent residence as a percentage of Canada's population, going all the way back to pre-Confederation. And you can see that the big spikes in terms of per capita immigration happened just before World War I, but they were cut short by the onset of a world war. But if you look at from 1990 on to the present day, despite sometimes the rhetoric that you hear about how immigration is growing incredibly and we're receiving more immigrants than ever before, that's not really borne out when you look at it over a long history. Immigration is growing, but it's not super dramatically. I will also point out that this is permanent residents, and we also have temporary residents coming to Canada as workers. As temporary foreign workers, we've heard a lot about the seasonal agricultural workers, especially this year during COVID, and also international students. Those are temporary, and some of them will become permanent residents in the longer term. And this shows immigration levels to Canada over the past decade or so by different class. So the top bar, the blue, is showing you a general increase in immigration. If you look at the orange, that's economic class immigration, and most newcomers to Canada are coming in those economic categories. And then the green is family class, that is people who sponsor family members to join them in the country after, like, often one family member or more will come first, get established, and then sponsor family members to join. And then the lowest category are refugees and protected people. We heard most about these during the Syrian refugee crisis of 2015, 2016, when Canada welcomed more than 40,000 refugees from Syria, including close to 2,000 who came to Hamilton. So switching gears to Hamilton, about 1 in 4 residents of our city is an immigrant. That is, they were born in a different country. However, a lot of this immigration locally is not new. Over half of the immigrants in Canada actually arrived before 1980, which means not necessarily that they're old, but they were by definition born before 1980, so they're at least 40 years old. And many of them are quite a lot older. We have a really growing senior population that are immigrants. We also have in Hamilton a number of, as I mentioned before, international students. That had been growing a lot until 2020. In recent years, with about 10,000 international students in Hamilton going to McMaster University, Mohawk College, and also Columbia International College, which is the largest private international boarding school in the country. We have about 2,000 secondary students living in Hamilton from a lot of different countries around the world, but 3/4 of them are coming from China. So this is showing immigrants in Hamilton by country of birth. And this is not recent immigrants, these are immigrants overall. So you can see that United Kingdom is still really big in Hamilton, followed by Italy. Until recently, Italian was one of the most common spoken languages in the home in Hamilton, but followed closely by more recent contributing countries, India, the Philippines, going back to some Southern Europe and Central European countries, and then farther on down. But if you look at recent immigrants to Canada, that is defined as people who've come within the past 5 years, then the picture looks really different. And I should say that this data is from the 2016 census, so it is taken in 2015. So these are people who have come basically from 2011 to 2015-16. So there, no surprise, Syria is at the top, followed by Iraq, the Philippines, India, and Pakistan. So the source countries shift a lot when you look at who is coming in recent years. United States is always in the top 10 or so overall and recently. And also looking at the languages spoken at home, and you can see a shift from 2006 to 2016 with the growth of Chinese and especially Arabic languages. The Chinese languages are combined Cantonese and Mandarin. So if you separated those into the actual languages, then Arabic would be first. And also Spanish is very prominent in Hamilton at this time. But Italian is still holding its own, but it's not being replenished by new immigrants from Hamilton at this time, from Italy at this time. So I'm speaking to an audience of realtors mostly. I don't have a lot about commercial real estate, but in terms of where immigrants are living and buying homes, if you look at where recent newcomers are living, they tend to be quite concentrated in certain neighborhoods in Hamilton. Just if you see the darkest areas are the areas of the highest concentration. And if you're familiar with these neighborhoods around the city, you'll see that like Corktown and Durand East, also Strathcona and Central, Beasley, Lansdale, those are all downtown neighborhoods. And then Riverdale West is farther out on Centennial Parkway. And all 5 of these areas are home to large market rental apartment buildings. And they often provide affordable place to live when people first arrive and they're looking to move to save assets, and then eventually often to buy a home. The rates of home ownership among newcomers are quite high. I should have looked up this stat, but it's something like 85% of immigrants to Canada are homeowners within 5 years of arriving. So it's really quite remarkable. Many newcomers buy homes right away. They bring assets with them, and it's very important to have home ownership. If you look at longer term immigrants, that immigrant overall, you see that they're much more dispersed throughout our city. And I think of particular interest is one of the biggest areas for immigrants living is in the Meadowlands and Ancaster, and those are relatively newer builds out in a suburban near suburbs. But you still see some concentration downtown and in Riverdale West and Strathcona and Central area. Oops. So I wanted to just say a few words about what the Hamilton Immigration Partnership Council is, because that's why I'm here today. We're not a direct service provider. We're funded by the federal government and housed in economic development at the City of Hamilton. And we bring together a lot of the local stakeholders who have a role to play in immigration. We've been doing this for just over 10 years now, and we're one of 77 local immigration partnerships across the country. Essentially, immigration is shared by, it's mostly a federal responsibility. The province also has some jurisdiction, but when we think about where newcomers settle, they are by and large settling in cities, especially larger cities. And so the local immigration partnerships are an attempt by the federal government to bring local stakeholders together to make sure that immigrants have a positive settlement experience. So our council has on it the 2 post-secondary institutions locally, 2 of the 3 anyway, McMaster and Mohawk. We have both school boards, all of the main settlement providers, institutions such as the YMCA, the YWCA, the Hamilton Chamber of Commerce, some private sector representation through the Hamilton Spectator and RBC Bank of Canada, and the like. And we meet and coordinate planning around immigration issues locally. So Hamilton, HIPC is part of economic development, and we help when visiting delegations are thinking of investing in Hamilton and in our city and looking for what Hamilton has to offer. We provide information about that, and we help newcomers connect to jobs, not really directly through service, but through pointing them to resources that our partner organizations provide. And we also work with our colleagues in Global Hamilton around business startup and helping newcomers to know where to go and how to navigate the regulations that are required to know about when. This is our team. I think some of you will know Tammy Huang, my colleague who is in the Global Hamilton office, and also Rashad Elani, who is the communications associate for HIPC. And this is our contact information if you want to get in touch. And one final piece that I wanted to mention that I didn't have a slide for, but what is this prospect for immigration in Hamilton and in Canada more generally because of COVID? You may be aware that immigration essentially came to a stop in the middle of March. And so prior to that, in 2019, Canada had received its highest number ever of applications for permanent residency. The 2020 numbers are, of course, expected to be much lower. The federal government is ramping up immigration right now, again, but it's expected that numbers in 2020 will be considerably lower, including for international students who are coming here just temporarily, but often will decide to want to stay in Canada after graduation. So this has a lot of long-term impacts for our population growth. Alex mentioned the importance of population growth coming from immigration. In Hamilton, it's about 2/3 of our population growth is coming from immigration. And so if we don't attract immigrants, then the growth of our city is under severe strain. And I'll just close with that, and I'm happy to answer any questions when the time for questions comes.
Perfect. Thank you, Sarah. That's very interesting as well. Obviously, COVID's put a pause on everything, but we shall see kind of once it's over what if it kind of continues on the same path and where it goes from there. But yeah, definitely have a couple of questions on my side after this, and we'll get into it after this call. But yeah. For now, we'll maybe pass the torch over to Peter. So Peter, feel free to take it away.
All right. Okay. Thanks, Ben. So share my screen here. And yeah, good to go. All right. So yeah, Sarah mentioned I'm indeed an immigrant. In 2010, where I lived with my family until 2018, and moved to the big city of Toronto as my business was growing. And I'll get into that later. I'd like to share with you today, and it ties into a couple of comments that have been made both by Alex with regards to investing in real estate project, which a lot of it happens in the private markets, as well as to Sarah's point, new companies, startups looking for capital, and how can we help these companies to raise capital, and how can we open it up for the wider investor community. So first of all, in general, typically you hear a lot about the public markets, the first golden rule of investing. I would like to ask the audience, what is the first golden rule of investing? Well, let me show you something. Maybe that brings you closer. What do we see here? A lot of sheep going over a cliff. So avoid herd mentality. That's typically what we don't want to do in the public markets. And we've seen a lot of that in the last couple of months, both sides, down and up. And that's not what we're not going to talk about today. We're not going to talk about the public markets. We're going to talk about really the private capital markets. In North America last year, over $3 trillion US dollars, twice as much actually went into private markets compared to public equity and debt markets. And it's often sort of misunderstood or unknown that the private markets are so big. And of course, that includes larger investments in large private equity projects. It also includes public companies raising capital in the private markets, but it shows you how important the private markets is and how big it is. And we also see in terms of growth that it has been growing twice as fast compared to public equities. So this is clearly an important. Private market is clearly an important market to further look into. And that's here we have a speech from. Sorry, I'm just struggling here with moving my. That's better. By the SEC, the Securities Exchange Commission Chairman Jay Clayton, on a speech in 2019, where he made a couple of comments about how important it is to open up the private markets to the wider public. First of all, as mentioned, the private markets outpace the public market. Secondly, the Main Street investors lack access to private markets. Typically, it's wealthy investors, venture capitalists, institutional investors that traditionally have access to investment opportunities in private markets. So we need to have a fresh look at how can we increase access to Main Street investors to private markets. And Main Street investors is indeed really everyone, all of us, whether you're wealthy or whether you're a smaller retail investor. How can we provide more access to the Main Street investors? And also people wish they knew more about investing earlier, and they wish they got started earlier. And and it also extends to the opportunity to actually invest in young emerging companies that are not big yet. Looking, of course, along the way, they continuously need capital. So how can we open up those kind of investment opportunities to the retail investor? And of course, there are numerous examples of big successful companies, often also created by its own customers. What if we provide those customers access to investing in those companies? What if we could have invested from the very beginning in Facebook or in Twitter or in Amazon or those kind of companies, which of course are the unique big winners, but that's what we're talking about. How can we increase access? So private is kind of the new public. Lots of the attention is really shifting from public to private. As mentioned, it's growing twice as fast, twice as much money raised, and also in terms of returns, we see that the average returns of private markets over public markets are actually 3.5% point higher than in the public markets, and that's basically estimated by or calculation from a recent BlackRock report. So, what are private markets investments? They're illiquid typically, such as private equity investments, meaning there's typically no secondary market for it. So they're illiquid. They're direct investments in private companies, real estate, as we also already talked about today, and also in infrastructure. And they're non-publicly traded debt. So it could be both equity debt and any other kind of hybrid forms of financing that are investment opportunities in the private markets. So the private markets investing is actually already went mainstream in other geographies. For example, in the UK, where early stage, so startup companies, about 40% of early stage companies already raise capital by going out to the public, going online, and raising capital from Main Street investors. In the US, we see that it's catching up very quickly, and online investing is really taking off with a number of investment crowdfunding platforms. And here in Canada, we also see, and as in Canada, we have the channels that we have not one federal securities regulates, but 10 provincial ones. So that's been kind of challenging in terms of harmonizing and introducing new rules. But we also see here in Canada that it's opening up, and it's making more easy for companies to raise capital from the public, and from the public to invest in these companies. So a couple of sort of tips here. If you haven't invested in online before, look for a curated platform, not just a listing site. You're still investing your money, and you want to make sure that it's a reputable platform that looks at these deals and not just going through a sort of a Craigslist and you have no clue what you're investing in. So curate a platform. Check for what these platforms do in terms of due diligence. How do they screen these companies? Keep in mind that online investing, it's convenient anytime, not just during business hours or whenever you want to do it. The whole point is that you can transact online just by like buying a book on Amazon at any time of the day. All key information should be available. Check the offering on the platform. If you have any questions, ask questions, go online, call, chat. Typically, companies raising capital through these platforms or organize webinars and live events where they are meeting with prospective investors, so you can inform yourself. And then assess whether you want to invest in a company and at what level. And keep in mind, it's often unknown, but you can invest in private companies also through registered plans like TFSA and RSP, and thus basically make it eligibility for tax credits. And this is the whole point about investing online. You complete your investment online, from learning about the investment opportunity to subscribing to transfer of funds. Everything happens online. And in that respect, in the same way as you, again, transact through an online e-commerce platform where you purchase products. That is really the power of online investing, and often called equity crowdfunding. So a couple of more points. I already made that point about the return expectations. Often people ask me, what do I actually really do return in private markets? Shouldn't I stick to investing in public markets, public securities? And again, if you look at the comparison with fund managers, and this is a report by BlackRock Investment Institute, you do see on average a 3.5 percent point better performance over large cap global equities and public securities. So we touched upon that. Private investments are typically illiquid. Now, is that an issue? And it actually turns out that that typically doesn't really need to be an issue. Investors' cash flows don't appear to be an issue for most decisions to allocate to private markets. In other words, reports show that only if you need your investment funds for more than 8% on an annual basis, then you would really have to cap your investments in private markets, because again, they're typically longer term investments and illiquid. So what that means is that whether you're a large investor or small investor, it makes a lot of sense to look at private markets investment opportunity as part of your investment portfolio. And then here's the point, go forth and diversify. Investing into and within the private markets is an opportunity for any investor. Again, whether you're a retail investor or you're a larger, high net worth investor, it's an opportunity to diversify your portfolio by investing in private markets. And of course, within private markets, you want to diversify as well and invest in different stages of developments. If you invest in companies, early stage companies, the growth companies, equity versus debt, industry sectors, including real estate, and of course the number of investments. Now, through platforms, online platforms, you can typically invest for as low as a couple $100. So it enables everyone really to diversify and make multiple investments in the private markets. Now, here in Canada, we also have the let's say unique Canadian connection in terms of the fact that we have 3 junior exchanges in Canada. And so companies in the private markets that raise capital in Canada have an opportunity to as one of their options to create liquidity is to actually go public on one of the 3 venture exchanges in Canada, TMX, CZ, and NEO. So Canada, in that respect, has sort of a unique positioning from early stage companies raising capital to creating liquidity in one of the by going public on one of the venture exchanges. A little bit about my company, FrontFundr. So FrontFundr is an online private markets investment platform, equity typically called equity crowdfunding. And the whole point is that we basically created the front-to-end platform that is fully digitalized. It's accessible to everyone, large and small investors, and therefore it's inclusive. It's really about providing access to private markets opportunities. We're the first online private markets platform operating in Canada from coast to coast. We've got today over 18,000 users. We've closed over 15,000 capital raises since launch in 2015. And we helped raise in total over 45 million Canadian dollars. We like to practice what we preach, or drink our own whiskey. We've raised capital through our own platform. So we've done 3 successful rounds for FrontFundr through FrontFundr. As we are also an emerging and still an early stage company. And today we're leading online funding investment platform in the private markets in Canada. Just wanted to share this success story we recently had this was in June. So this is a company. It's a vegetarian food company. And they called the Very Good Food Company, and they raised capital on FrontFundr 2 years ago, where the minimum investment was $250. So over 240 investors participated in it round, raising just over $600,000. And at that time, the price per share was 12 cents, and so that round was closed in 2018. Now, what happened is that they went, as I mentioned earlier, public on one of the exchanges. In this case, the CSE, the Canadian Securities Exchange, and they listed in June of this year. And the latest closing I saw Friday was $1.77. So this is what we like to see, of course, an outlier as well. But this is a good example of how we enable, through equity crowdfunding, the public to invest at the very beginning and to help founders build their business and also share in the upside and the success. Now, COVID-19 and online investing, a couple of key trends we've seen in the last over four months is COVID-19 has been an unexpected catalyst to accelerating the shift toward online investing. Just as we all went even more online to purchase products, we see a similar we see a similar trend in online investing. Actually, on FrontFundr, we've seen in the last 4 months, peaks in visits, peaks in number of new sign-up, number of investments, and also companies coming to us that are interested to raise capital. So the whole the shift towards transacting online that most of us already used to in for most other products now seems to also kind of accelerating with regards to investing in private companies. It's important that there's an additional channel of capital, because venture capital is clearly disrupted, and there's since COVID broke out less available. Many VCs are focusing on their portfolio companies to help them get through. So even more reason to tap an additional pool of capital from the public to make funding available to startups. And more startups should really look into online fundraising. It's unlike venture capital firms. Online capital raising platforms are very well positioned to help startups currently, but also moving forward in the post-COVID world we will live in. So key takeaways: you now have access to investing in the private markets through online platforms like FrontFundr. You can diversify into and within the private markets, and anybody can do that typically because the minimum investments are much lower. You can invest in companies that you believe in, really, and you can do that from the very beginning. You're getting in on the ground floor indeed, and so you have to be ready for the long game. And typically you maybe have to be patient for 5 to perhaps even 10 years. And as mentioned, COVID has been a catalyst for accelerating shift towards online investing in private companies. That's it for me. Thank you.
Thank you, Peter. We've just reached this time, I guess, the end of presentation. So we do have a few questions. Maybe we'll start with questions from the audience. So we'll start with you, Sarah. Joe has asked, do you think Canada is still seen as a top choice internationally, and that immigration is going to get back to high levels eventually, assuming once this COVID-19 situation is over?
Yeah, absolutely. I think Canada has a long history of welcoming immigrants, but they have a very sophisticated systems for processing and determining categories. It is very complicated in that there's probably more than 70 different streams that you could come to Canada. So you really need the help of a lawyer now more than ever in order to know which options are best. But the political and economic stability of this country and its international reputation for acceptance of diversity and newcomers means that it will continue to be an important immigration country. I would be remiss if I didn't mention that Canada is also really benefiting from political instability south of the border and the lack of welcome that is being given to potential immigrants. And so international students and people considering immigration alike are looking to Canada more than ever before. So the prospects are good. I think we're just hurt in the short term in 2020, especially. And especially also as other countries see development and as there is a shift towards more remote working options, you may see that individuals, especially highly skilled individuals and tech sector workers and the like, may make decision to stay where they are and to try to work remotely in North American companies. So I think that is another trend that we are likely to see. But Canada will remain attractive as a potential receiving country for immigrants. Thanks for the question.
Yeah, very well said. You mentioned that HIPC, you have some initiatives that you guys implement to help immigrants start businesses and kind of get settled in the area. Could you explain a little further what perhaps some of those initiatives might be?
Yeah, well, HIPC, we focus on settlement of newcomers after they arrive, but we work a lot with our colleagues in Global Hamilton and at the Hamilton Business Center located on the first floor of City Hall. So we tend to pass people off who are interested in investing. I pass them off to my colleague Tammy Huang often. But there are a number of initiatives, micro loan programs that have been set up specifically with newcomers in mind for credential recognition, for business startup. There's also some programs through the province for business startup that offer not a huge amount of money, but like $5,000 in grants to start a business. So we connect there. I think the important piece of what we do is, if I use the word concierge, it's maybe a bit strong, but we provide kind of a face and a contact within the city to help people to navigate that bureaucracy that I think is, in Canada, things are very highly regulated. For many people who've owned businesses in other countries, they come here and they're surprised to see like how many hoops they have to go through in order to set up something, zoning, licensing, et cetera. So we can just assist with that. So feel free to contact us.
Great. Looks like we have another question here for Alex from Libya. She says, great presentation. Alex, what is the state of development for Hamilton post-COVID? Have projects stalled?
Specifically, I can think of, well, the general answer is yes. And that's just to general construction or just general COVID measures that were implemented on the construction industry as a whole. But has it plummeted projects? Has it thrown projects in the trash can, I guess? From my knowledge in Hamilton, I can't think of one that's been completely removed because of COVID, even though it is a strenuous time. I think what you've seen during this time, especially at the beginning of this quarter, is the construction projects that people have been taking advantage of is, I guess, the current assets that they can potentially retrograde or renovate, I should say. Whether that be they were just currently vacant and the construction they can do right now is interior and they're just taking advantage of that, or is it to implement measures that may be more attractive for a post-COVID world that would implement like health and safety features. And then the government will also recognize this. I can't remember what it was called exactly, if they put a name to it, but they did eventually approve permits that had foundations all ready to go. They enacted measures where there is a certain amount of people that could be on site at one time. And I think they introduced different shifts to accommodate the lessening of people on site. But just even we work downtown Hamilton. There's a number of projects going around us, and I'm currently seeing things moving along, and including cranes. So it does hamper construction timelines, but they are still moving forward in Hamilton for the most part.
That's good to hear. So for Peter, I have a question for you here. Obviously, with COVID, it's certainly taken a hit to the venture capital and angel capital being placed in the private markets. Do you see equity crowdfunding going to replace some of those more traditional sources, or will it kind of go in unison? What are your thoughts there?
Yeah, so that's a great question, and it's been even apart from COVID, sort of a topic around equity crowdfunding. Is this the new way for companies to raise capital, and is it indeed going to replace the traditional channels like angels and VCs? And I think, and also looking at other geographies, as I mentioned in my presentation, where equity crowdfunding is already kind of further along than here in Canada, is that it's basically, in a way, it's an additional, a new alternative channel to raise capital, and so it's a new tool in the toolbox, if you like, for companies to raise capital. You see successful examples in the UK where companies, certainly if it's a consumer good product or service, where it makes sense to go out to the wider investor audience, where it's easly to convey the message and sort of where investors can associate with it. and therefore may be interested to participate, to look for a combination of raising through angels and VCs, as well as through investment crowdfunding. And so that's kind of the end game. I see that go hand in hand in a way. And also, investment crowdfunding has a long way to go. It's still, certainly here in Canada, in its infancy, and it's basically an additional pool of capital. So it's the two sides: is unlocking these investment opportunities for the retail investor, so they can participate in these companies well from early age, and unlocking a huge pool of capital from this audience, together with the angels and VC capital to invest in these companies. So I see it more as an additional channel, rather than this is the new revolution and it's going to wipe out all the VCs and angels. That's not going to happen anytime soon.
No. That's interesting, though, that equity crowdfunding has maybe moved a little faster, caught on a little quicker in other countries. Why do you think it's been slower here in Canada to adopt? Yeah, and
I mentioned it earlier. Well, one of the reasons is definitely the regulatory challenges. In the UK, in the US, there is a federal regulator, and we don't have that here in Canada. We have provincial securities regulators, and obviously they talk, but they ultimately act autonomously. So what that means is that we have seen, unfortunately, when equity crowdfunding new rules were introduced, and this was around 2015-16, that they were quite fragmented, which is a challenge for both companies, because in each province there may be different rules, as well as for investors. In one province, investor may invest and the limits may be much higher, and another province investor may not have access at all. So that definitely has had an impact on kind of the growth rate of investment crowdfunding in the UK. There is a federal rule, same thing in the US, where the harmonization of crowdfunding is way ahead, and where there's been the pace of introducing new rules and increasing limits, etc., has been higher. So that's definitely has a factor, and another factor, it is typically investing in private companies. It's certainly, if you invest in early corporates, early companies, early stage companies, it's higher risk. So perhaps there's a factor of conservative investing, what we see perhaps here in Canada. Ultimately, we know kind of where the puck is going by looking at other geographies, and it will happen. It just takes some more time. What is, by the way, encouraging is that the regulators here in Canada as well are clearly now moving towards harmonized crowdfunding rules, which is likely to expedite growth of this way of raising capital.
Well, that's great, and I guess congratulations are in order. I guess the recent law that was passed. I think your organization had a pretty big impact in getting that across the line. So congratulations there. But I think for now, I want to be mindful of everyone's time. So I think we'll stop it there. I want to thank all of our speakers on behalf of the audience. Very insightful presentations. And for those that tuned in from home, thank you for joining in, and hopefully found the information insightful. But we'll end it there, and wish everyone a good day.
Thank you.
Thank you. Thanks.